Hi there, Nicholas Cabin here from First Formations, and welcome to another episode of Whiteboard Thursday, where we provide advice on a wide range of business and company matters. If you find this video useful and you enjoy it, please give us a like and share it with your friends and colleagues. But for now, let's get started. Today I want to discuss 10 of the biggest and most costly self-assessment mistakes that people make when completing their tax return, and what you can do to avoid them and lower your tax bill. So first of all, what is self-assessment? Well, this is the system that HMRC uses to deduct income tax from workers who are self-employed or generate income that isn't taxed through PAYE. If you earn an income that isn't taxed automatically by your employer, you'll need to declare it to HMRC and pay the appropriate amount of tax using a self-assessment tax return. It is important that you file your tax return on time, as you will incur a penalty for missing the filing deadline. Your return should also be free of mistakes, and the information submitted should be complete, as you could be penalised for not taking sufficient care in preparing your return. So without further ado, let's take a look at the costly mistakes that people make with their tax return, and critically, what you can do to avoid those mistakes. Starting with number one, no government gateway user ID. Very common mistake is forgetting to register for a government gateway account or by losing your original government gateway user ID. Both issues may prevent you from filing your self-assessment tax return and receiving a penalty if you are attempting to file it close to the deadline of the 31st of January. The government gateway is a method of verifying your identity when using HMRC online services, including self-assessment, and you will need a government gateway user ID before attempting to set up a self-assessment account. If you do not have a government gateway account, you can register on the sign in or register page of the gov.uk website. However, remember, you will need your national insurance number or a UK address and a recent payslip or P60 or a valid UK passport to register. And it will take about 10 days to receive your 12-digit activation code by post from HMRC. If you have lost your government gateway user ID, you can recover your user ID and your password on the gov.uk website. However, if you don't know the email address that you use to register your government gateway account, you will need to create a new one and wait for your new activation code to arrive in the post. Number two here is no unique taxpayer reference. Another very common mistake is forgetting to apply for or losing your UTR number. First-time self-assessment filers need to set up a self-assessment account with HMRC to obtain a unique taxpayer reference, say UTR code. Bearing in mind self-assessment deadline is the 31st of January every year, you've got to make sure that you have an active UTR number well before that date, or it could cause you to miss the filing deadline and then incur a penalty. Strictly speaking, you're supposed to register for self-assessment by the 5th of October every year. That being said, there's no automatic fine or penalty for missing that deadline. But to be on the safe side, you should always apply for your UTR at least 20 days before you've got to submit your return, as there is no such thing as a temporary or emergency UTR number. A UTR is a 10-digit code that uniquely identifies you as a taxpayer. After asking for your UTR code, it normally takes about 10 days to get your number through the post. It can then take another 10 days for you to receive your activation code that you'll need to access your HMRC online account. If you have lost your UTR number, you may be able to find it on previous tax returns and correspondence from HMRC, such as the notices to file or the payments reminders. In the event of not being able to find your UTR number, you should contact HMRC directly on 0300 200 3310. Once you have passed a series of security questions to verify your identity, they will post your number to you, which can take a further 7 days. This is the only way that HMRC will send you your UTR number, so don't leave it late. Number three here is forgetting your tax-free allowance. The absolute worst error that you could ever make when submitting your self-assessment return is to forget to take advantage of your tax-free allowances. When you hear HMRC talk about tax-free allowances, they're normally talking about your personal allowance. This is an allowance of £12,500 that gets applied to your tax account automatically, and you do not need to apply for this allowance. There are other automatic tax-free allowances that you should be aware of as well. For example, you can get up to £1,000 per year in tax-free allowances for any income that you generate from trading and property, known as the trading allowance and property allowance. If you have both types of income, you'll be eligible to £1,000 for each. However, there are some really helpful tax-free allowances that aren't applied automatically. And so you should do your research to find out what these are and if you're eligible. Examples of tax-free allowances that you need to apply for include the blind person's allowance. So if you or a spouse is registered blind, you can claim £2,520 per year. Then you have the marriage allowance, which lets you transfer unused personal allowance to your partner. And of course, there is the rent a room scheme, which allows you to earn up to £7,500 tax-free if you let out a furnished room in your home. Remember, there are a lot of tax-free allowances that HMRC offers. Before filing a return, make sure to do your homework so that you're not missing out on any of these schemes that could potentially substantially lower your tax bill. Going on to number 4 here, not planning for payments on account. One of the top mistakes that taxpayers make when filing their self-assessment return is not planning for payments on account. So just what are payments on account? Very simply put, a payments on account is an advanced payment that HMRC asks you to make towards your next tax bill. This includes any Class 4 national insurance contributions if you're self-employed. After filing your self-assessment, you will have to make 2 payments on account every year. Each payment represents half of your previous year's tax bill, and payments on account are normally due by midnight on the 31st of January and the 31st of July every year. That being said, it is important to bear in mind that you won't need to make payments on account if your last self-assessment bill was under £1,000 or you've already paid over 80% of all tax you owe. If you want to avoid getting the fright of your life when you see your next tax bill, you'll need to plan accordingly. You should do your best to start tucking funds away now for your payments on account so that you've got to hand when it's time to pay your bill. And it is worth remembering that if your business is expanding, you'll generally have higher payments on account, so be prepared. Number 5 here, not declaring the correct salary and benefits from PAYE jobs. If you have a job in which your tax is deducted through PAYE, you need to make sure that HMRC knows about it and that the income earned through PAYE is correct on your return. Otherwise, you could end up paying more tax than you need to. Thanks to making tax digital, the information is now typically generated on your tax return automatically before you even start filling it out. But the data is often incorrect. For example, your employer may not have reported your PAYE earnings correctly or simply may not have reported them at all. So you should always check the amount that you have earned and what's been taxed from your PAYE employment to make sure that the information on your return is correct. After all, if your employer has submitted the wrong number by mistake, it could end up costing you. Likewise, there may be situations in which some of your PAYE income hasn't been added to your return automatically. The best place to check your PAYE information is on your P60 or P11D. This will show exactly how much you earned and how much tax was paid in the last tax year, which can then be entered manually if need be. Number 6 is next, claiming ineligible expenses. There are many allowable expenses you can legitimately claim to reduce your tax bill. Allowable expenses are essential business costs that are required to keep your business up and running. They are tax deductible, which means that HMRC allows you to offset those expenses against your annual tax bill. And the examples of allowable expenses that you can claim are the office costs, so things like the office, property, equipment and stationery. Travel costs, so we're talking cars, vans, fuel, parking and train or bus fares. Clothing expenses, so protective clothing and uniforms. Staff costs, thinking salaries, bonuses, pensions or subcontractor costs. Things that you buy to sell on, so goods for resale or raw materials. Financial costs, so we're talking accountancy costs, insurance and bank charges. Costs of your business premises, so rent, rates, utility bills and business rates. Advertising or marketing, so this will include things like advertising, entertainment, subscriptions, website costs. And of course, training courses, which will relate to your business. There are important rules that you must follow when claiming expenses, and you should also keep records and receipts of all expenses claimed, as HMRC may want to see them one day. All expenses claimed must have been incurred wholly and exclusively for the purpose of running the business and be allowable for tax purposes. This means that costs should have been incurred while actually performing a business activity or trying to attract more business. If in doubt as to what you can or cannot claim, check out the HM Revenue Help Sheet, HS222, How to Calculate Your Taxable Profits, which includes a table of the most common allowable and disallowable expenses. Claiming ineligible expenses may have serious consequences. Apart from paying interest on the underpayment of tax, if you deliberately underdeclare tax payable, you could receive a penalty of up to 100% of your tax bill, although in practice this is normally around 10 to 30%. Number 7 here is not claiming on tax relief on private pension contributions. Now, do you make private pension contributions? Because if so, you can get tax relief of up to 100% of your annual earnings. This is especially important for higher rate taxpayers who overpay hundreds of millions of pounds in tax every year due to unclaimed pension tax relief. You get this tax relief automatically if your employer takes workplace pension contributions out of your salary, or you contribute towards a private pension and pay income tax at 20%, as your pension provider will claim the basic tax rate relief and add it to your pension pot. It is worth checking the basic rate relief has been claimed, as there are a handful of pension providers who don't actually do this. However, if you pay higher rate income tax of 40% or at the additional rate of 45%, you will need to claim the extra 20% and 25% through self-assessment tax return. This money will not be paid into your pension pot, but will instead be paid in one of the following ways. So as a reduction in your current tax bill, as a tax rebate, and as a charge in your, or change in your tax code. That is, you're going to pay less tax next year. HMRC will not remind you that you can claim this higher rate of tax relief on your pension contributions, or that you have to claim it via your self-assessment tax return. It is worth remembering that you need to do this every year. So if you have not done this previously, you may have unpaid tax relief that can be claimed for up to the 4 previous years. If you still have questions about how your pension contributions are taxed, the best place to start is the Tax on Your Private Pension Contributions page on the gov.uk website. Number 8 here, missing the filing and payment deadline. We have already talked about making sure that you apply for your UTR and register for self-assessment in time. But that's not the only deadline that you have got to remember. The HMRC self-assessment online submission deadline is the 31st of January every single year. HMRC did make a rare exception in 2021 because of disruption related to the COVID-19 pandemic. So the deadline in that year was extended to the 28th of February. But deadline extensions are fairly rare, and so you should not bet on it happening regularly. Instead, you should always plan to have your self-assessment return completed and submitted by the 31st of January. If you fail to send your return in time and you've not been granted an extension, penalties can range from a fine of £100 or even up to 100% of your tax bill. That means if you're late and you file late, you could end up paying twice as much tax. More important still, don't forget the 31st of January isn't just the deadline for filing your return. It's also the deadline for making your payment on any tax owed, as well as your first payment on account. And HMRC will charge you interest on late payments. That's why it is prudent to file early, so that you've got plenty of time to set money aside to pay your bill by the deadline. Number 9, not being aware of the high income child benefit tax charge. More than 7.2 million families in the UK receive child benefit every year, which can be a huge help in terms of making ends meet. But what a lot of taxpayers don't know is that they may have to pay a charge or a tax charge known as the high income child benefit tax charge if they or their partner earn over £50,000 per year. In England and Wales, the high income threshold is £50,000 a year. That means if you or your partner earn above this amount and are in receipt of the child benefit, you'll be liable to pay this charge here, resulting in the loss of all or some of your child benefit. The income used by HMRC to calculate the charge is known as the adjusted net income. If your income is between £50,000 and £60,000, you'll be charged 1% on every £100 worth of excess income. If your annual income is over £60,000, you'll be charged the full amount of the child benefit that you received. It is your responsibility to deal with this charge through the self-assessment tax return, so it is worth getting this right. And it could be a big shock to the system when it comes to paying your tax bill. Again, do yourself a favour and prepare accordingly. However, you do actually have options with regards to this charge. For example, you can reduce your adjusted net income by making a pension contribution, either as part of an occupational pension scheme or a personal pension, and so reduce the tax charge payable. Or if you earn in excess of £60,000, you may wish to elect not to receive the child benefit at all and avoid paying the charge and the hassle of dealing with it on your tax return. You can learn more about the high income child benefit tax charge on the gov.uk website. Number 10, not claiming charitable donations. Finally, everybody knows about claiming expenses to reduce your tax bill, but not everybody realizes you can also lower your taxes by claiming on charitable donations. Every donation that you make to a registered charity or a community amateur sports club, CASC, is 100% tax-free. These donations are normally made through gift aid. Gift aid is the most popular way of donating to charities because it lets charities and CASCs claim an extra 25 pence from the UK government for every £1 you donate. It is also worth mentioning that if you're a high earner and you pay tax above the basic rate, you'll be able to claim the difference between the rates you pay and basic rate tax on your donation. For example, let's just say that you are a high earner and you donate £100 to a local charity. They can claim gift aid on your donation to top up the contribution to £125 at no extra cost to you. You can either choose to claim £100 in your self-assessment return to lower your tax bill, or you can choose to claim all £125 as long as you're willing to pay 40% tax on that £25. The former is a little bit more simpler and is the one that most filers go for. But if you've made some hefty donations that have been submitted using gift aid, you could end up shaving even more money off of your tax bill by paying tax on the difference and claiming gift aid. So far, we have covered what we consider to be the biggest and most costly mistakes that people make in filing their tax returns. However, these are just the tip of the iceberg and there are many more. We've got a small selection here of common errors that could potentially cause you delays and problems, and so it is a good idea to try and avoid them. Starting with poor arithmetic, making mistakes with calculations on your return. Using the wrong tax code. Make sure that you are on the correct tax code. You can check it on the tax codes page of the gov.uk website. Incorrect national insurance or UTR numbers. It is important to submit these accurately and not to enter them incorrectly on your return. Then we have incomplete information. Writing to be confirmed or information to follow is not acceptable to HMRC. All information required must be submitted. Then we have things like ticking the wrong boxes. This is a very common problem that can be avoided by using the HMRC guide included in the tax return. Then we have not reporting interest earned on savings, forgetting to report the interest that you make from savings and investments. Failing to declare all income, forgetting to declare a source of income or under-declaring income could lead to serious problems, including prosecution. Not declaring capital gains. Remember to declare income from capital gains, such as the sale of property, a business, or shares and so forth. And of course, lastly, forgetting to sign and date your return. This one is probably only relevant to those undertaking paper tax returns only. Now let's consider what to do if you make a mistake in your tax return. If you discover an error in your tax return, you have 12 months from the submission deadline to amend it. You can make amendments and refile your return by following HMRC's guide on tax return corrections. Your tax bill will be updated based on what you submit, and you may need to pay more tax, or you may be entitled to a refund. If HMRC finds problems with your return, this could result in paying more tax and receiving a penalty notice. However, if you've taken reasonable care with your return and made a genuine mistake, no penalty should apply, and you have the right to appeal the penalty notice. It is also worth mentioning that HMRC may decide to open an inquiry to investigate your tax affairs if there are inconsistencies between your different returns, you file returns consistently late, and or the costs are significantly higher than the industry norm. And there you have it. So today we have covered our top 10 self-assessment mistakes that people make when completing their tax return, a selection of other common errors, and what to do if you need to change your return. Completing self-assessment accurately and on time is incredibly important if you want to keep your tax bill as low as possible. So you should do your homework beforehand and make sure that you know all of the facts. If you have multiple sources of income and your return is quite complicated or are simply unsure as to what you are doing, we recommend seeking the assistance of an accountant who will ensure that your tax affairs are handled properly. All tax rates and allowances quoted in this video are current for the 2021-2022 tax year. Any changes to these rates will be available in our blog, the top 10 self-assessment tax return mistakes and how to avoid them, the link for which is available below. If you have any questions, please do leave them in the comment section below. In the meantime, be sure to subscribe to our channel to get more advice on limited companies, reporting requirements, and tax obligations. We're always happy to hear from you, and we cannot wait to help. Until next time, cheerio.